Hi guys, welcome to the first session on financial management. I hope all of you can hear me. If you all can hear me, can you just put a message on chat that I am audible? Great, thank you very much. All right, great, super. Well, unfortunately, this is the new norm, the new normal. We don't get to meet. We meet online through a virtual classroom, right? So I'm here physically present and speaking in front of some empty seats, which is very unfortunate. So let's try and make this an interactive session, right? So feel free to ask questions. If ever you have any question, just don't take any questions to the next week. Just make sure you sort them out then and there. We're talking about the subject. Very brief overview is there is good news and bad news, right? Which one do you want first? Do you want the good news first or the bad news first? Bad news first is the pass rates for the subject is around 20%. Yeah, just about 20, maybe around 25, which is not that great. But then the good news is, it's having said that, it is a very easy subject, right? I just don't understand why people fail. Because if you want to fail this subject, if you want to fail financial management, if you want to fail, you'll have to try very hard. Extremely difficult to fail, but still 75% manage to fail. Why? I don't know. It's in my view, it is a matter of things boiling down to interpreting questions and how you answer them. And so if you pay attention, if you are focused, if you are exam focused, more importantly, then you're almost guaranteed of getting through. A very simple exam. I promise you, after grade 5 scholarship, right? After grade 5 scholarship, this is going to be the easiest exam you would have ever done. A grade 5 scholarship is simple enough. So this will be the second easiest you did in your life. And it will remain the second easiest in your life. You won't get an exam which is easier than financial management, right? So it's a real challenge to fail. To pass, if you just be in touch, right? If you have the discipline, if you understand, not in detail, but if you have a basic understanding, just understand the basics, get the basics right, then you're through, guaranteed. There's absolutely no reason to fail, right? Once again, I repeat, this is the easiest subject you're going to do in your life. Maybe after grade 5 scholarship, perhaps easier than that also. Okay, so any questions up to now? I'll be happy to take any questions that you might have on the subject. By the way, feel free to interact. You can type anything you want on chat, anything meaning anything relevant to the subject. Don't type anything very personal. Yeah. Right. So if we were meeting in a physical classroom, okay, there are still people logging in. Right. If we were to meet in a classroom, we would have started off by doing a round of introductions, right? Where I would have asked each of you to introduce yourselves to me. That way I know your backgrounds. I know where to pitch things, whether I should pitch it at 33,000 feet or at ground zero. Yeah. But unfortunately, online classes doesn't warrant that. So we'll have to move on with what we have. So as I said, just feel free to ask questions if you have any. I'll try my best to answer all of your questions. Right. Yeah, so all of you would have got your tunes. Right, so let's start with an overview of what we are getting into, right? Now, financial management is, there is absolutely nothing new to learn. Yeah, because all of you are, any of you straight out of school? Is anyone straight out of school? How many of you are not bankers? All of you are bankers? You work for some bank?
Yes, sir. Yes.
Okay.
Yes, sir.
Yes, sir.
Jain is an undergraduate, okay. Right, about anyone who is not employed in a bank, who doesn't work for a bank, other than Jaini? Only Jaini. It doesn't matter. Being a bank would help, but even if you're not a banker, it doesn't mean you will not understand anything, right? In fact, you might understand better. Okay. Once again, getting back to the overview, it's about managing your funds. Now, why I asked whether all of you are employed is because that means you all are salaried, right? So you'll have inflows as well as outflows. You will have received your salary maybe on the 20th or 30th or whatever, and you'll have to manage 1 month with what you receive, plus whatever the other income that you earn, right? So you'll have to pay your bills, you'll have to pay for the family, or food, all that has to be covered with the salary, right? So it's about managing your funds. How do you manage your funds? Sometimes you might end up with a positive balance, right? Let's assume that each of you earn $100,000 every month. Right? Just assume. So after all your expenses, if you're left with, let's say, 25,000 at the end of the month, when you have a surplus, now what are you going to do with this money? What do you all think? If I may ask you a very simple question, if you're left with 25,000 rupees a month, every month, after meeting all of your expenses, what is the next thing you're going to do?
Sometimes we think of investing in a fixed deposit.
Investing in a fixed deposit. Very good.
Yeah.
Very good. What else? Anyone else?
Joint treasury bill.
Okay, treasury bills. Yeah. What is your name?
I'm Sumed. I know. I think you know me. I'm from HMB. Kovala.
Ah, okay.
Sumed.
Of course, all friends. Hi.
Yes. Hi.
Right. So I might be knowing some of you in this class. Unfortunately, I can't see you all. Yes, Dinesh, you're right. You can buy shares. You can put money in a FD. And Sumit mentioned something else in treasury bills. Yes, treasury bills, FDs, shares, very good. You can save, okay. Maybe you can invest in a unit trust, or perhaps you can buy gold. Right. Now, interestingly, there is a new instrument which is coming in called Real Estate Investment Trust, REITs. Right, REIT. It's still a new product, recently introduced. Right, so that's another option you can evaluate now, which means all of you are managing your funds one way or the other. Right. So that's if you're left with 25,000 rupees now. But what if you're short of 25,000 rupees? You had a surplus, then you invest somewhere. What if you have a deficit of 25,000 rupees?
We have to borrow.
You have to borrow. Very good. What are the sources of borrowing?
Request for a loan from a bank.
A loan, okay, maybe a personal loan, right?
Personal loan. Yeah.
Yeah, so maybe a personal loan from a bank. What else? Housing loans. Now, last week at the monetary policy announcement, warning advance. Okay, credit card. Yes,
Credit card.
warning. Okay. And when you borrow, you borrow from the cheapest source or the most expensive one?
Cheapest source.
Cheapest. But then housing loans are the cheapest. No, 7%.
Yeah.
Can all of you borrow on the housing loans?
No, no.
So
That
it's
is
not
only for the housing purpose.
only for housing purposes, right?
Yeah.
So which means it's not only the price. No, there are other things that you need to consider. How fast you can get the loan? Can you get it within a day or two, or does it take a couple of months?
Yeah, but housing loan, it will take about 1 month.
My experience is very different.
Yeah. Then.
At your branch.
Okay. I think you got it early, no?
No, it took 6 months, more than 6 months.
6 months.
Yes.
I don't know. Mm-hmm.
Yeah.
Was there any any problem with the documents?
No problem.
Nothing. All were given, but took some time to process.
I don't know what went wrong, but anyway, finally I got it. So that's a good news. So
I was surprised to hear that. Got 6 months.
I was also surprised. I was also very surprised. Yeah. So it's not always the price. There are other things that goes into your decision.
Yeah.
Yeah. Maybe the flexibility, terms and conditions, all that applies. So financial as well as non-financial factors may apply.
Yeah.
Right. Then perhaps the purpose for why you need the funds, for how long you need the funds. So there are so many things that you need to look at. Okay, so the bottom line is we might have a surplus or a deficit. Either way, we need to manage in between. So when we are managing, we are already knowing or unknowing, we are managing our finances. That's called financial management. Right? So every day we do this. Day in, day out, from the moment you wake up until you go to bed, you do financial management. Sometimes in your dreams also, you manage your finances. Right? So there is nothing new to learn. Nothing new at all. Which means there is nothing new for me to teach also. Yeah. Okay, so we can close to this session. Nothing to teach. We can all go home, isn't it? Yeah. I'm just kidding. I don't log out. Class is not over. Right. So this is what we are going to cover. We are going to learn how to manage funds and cash flows in a profitable and safe manner. Now, having said that, there is no way of you or me guaranteeing that you will make profits. You might make losses. You never know. By the way, this 7% housing loan, it applies to existing loans or new ones only?
It's for new ones.
New ones, okay.
Yeah.
That's bad news. Okay.
But anyway, central bank has advised the banks to reduce the rates, but I don't know how far they have. The banks have, they have done this. How far the banks have followed this so far. But anyway, it will come. It will come in the near future, and every bank has to follow what CBSL says.
All right. Susita is also very quick to respond, saying only for new loans. Very good. You can't convert existing ones. All right. Good. Bankers, no? Risk return trade-off, right? Meaning, now you can invest with Sakwiti Ranasinghe, right? He gives a 50% return, but will you do it? You might not. Why? The risk is very high. Right, so corporate finance, how corporates manage their finances, treasury and fund management, financial engineering, fundraising instruments. We will do some of the instruments, how you manage your liquidity, your investments, financial planning and forecasting, how you prevent frauds, at least how you try to prevent frauds. Then to provide an excellent service to corporate high net worth clients. This is the good news. There is a lot of number crunching in this subject. So that's good or bad news? You like numbers? Good news.
Good
Very
news.
good. Okay.
Yeah. Rather than theory, when numbers comes, anyway, we can stick to the numbers.
Yes, you're right. Very good.
More than, I mean, theory means what we had to memorize, and that's a kind of like we can't just memorize things always.
Good, good. That's the kind of attitude you need to have. You need to be positive about this. Huh? Excellent.
Yeah.
Right. So this is what we're going to cover. We'll be covering fundraising instruments, ALM, treasury portfolio, financial analysis, planning. Right. You don't have to study the first few slides. Right. So let's skip these areas. Right. So under the new normal. Now, what are the changes you all have noticed? What has been driving markets over the last 1 year? Not 1 year, maybe 6 months?
Digital. The bank has been moved to digitalize.
Okay, so what was the driving force behind it?
Pandemic.
Yeah, driving force is actually we can't. The customers can't reach the banks, so they have to use the other alternative methods. How to do their transactions at home. When they are at home, they can always use the digital transfers if they have e-banking or some kind of this electronic media, like electronic ways of doing transactions.
Yeah.
So they can do it at home.
Yeah, so what caused all the changes? Was it actually
pandemic?
The pandemic caused innovation, right?
Yeah.
So it's a well, what revolutionized the industry was it was quite an accident, wasn't it? It was not planned. Now, last year, if someone had told you that 6 months down the line, all of you will be working from home, how many of you would have believed it? I wouldn't have. And I'm sure most of you wouldn't have either. Right? But now we find that almost all of us are working from home. Yeah. So things change very quickly. So COVID-19 has changed. It has turned our lives upside down. Okay, so COVID-19 was it was a medical crisis, right, which propagated in China, and today it has become a financial crisis spread all over the world. Not only in China. Maybe China has almost come out of it, but the rest of the world is now very much into it. Right? Battling COVID-19, struggling to get out of it, perhaps. So financial crisis, sorry, a medical crisis ended up being a financial crisis, fully blown financial crisis. If you go back, right, turn back the clock 10 years to about, sorry, maybe 12 years to 2008-9, there was another crisis. What was that crisis called?
Terrorist.
Pardon?
Terrorist.
No. Yeah, we had a war, but not the war. There was a financial crisis.
12 years. That
Global financial crisis.
Wall Street Bank.
What's that?
That is the Wall Street Bank has collapsed. No, so with that the financial crisis has happened.
Yeah.
It has affected almost every country.
Yes, Lehman Brothers collapsed. So what was the financial crisis called?
Subprime mortgages.
Yeah, subprime mortgage crisis.
Okay. Yeah.
Right, subprime mortgage crisis. That was where the subprime borrowers found it difficult to service their loans and they defaulted. Financial institutions went into liquidity problems. Some Lehman Brothers went bankrupt. Some of them had to be bailed out, and the Federal Reserve ended up printing lots of money. Right. Then 10 years before 2008, 96, 97, there was another crisis. What was that? Before you all were born, perhaps. What was the crisis during 96, 97? 97, I mean. It was called the East Asian Economic Crisis. Right? East Asian Economic Crisis. Now, this is where some of the East Asian countries like Malaysia, Philippines, right, and Thailand, they experienced a severe drain on their reserves. They were very adamantly defending their currency, the local currencies. They were artificially keeping it strong by spending their reserves, and these countries ran out of reserves. And the currencies weakened, they went through the roof, and these economies were in a huge crisis. East Asian economic crisis. Now, people like George Soros made a lot of money out of the East Asian economic crisis. He actually took on the Malaysian Central Bank. Right? So every 10 years, roughly, there is some sort of a crisis. Something happens in the world. I think in 1977, there was an oil crisis. Oil prices just went through the roof. Right? So likewise, every 10 years, there is some sort of a financial crisis. It's a cycle. So the good thing is after a crisis, the economy recovers. Sometimes it is a V-shaped recovery like what we are experiencing and like what the world is experiencing. So a crisis is also an opportunity for you all to invest and actually to invest, right, in a profitable or a potentially profitable venture. Right now, for example, look at companies like Zoom. The market value of Zoom or the market cap of Zoom has gone beyond that of Boeing. Right? Boeing, with tourism industry collapsing and travel trade coming to almost a halt, the market value of Boeing has fallen below the market value of Zoom. Right? It shows how dynamic our economies are. Right? Now, Tesla, right? If you recently I read an article that if you had purchased 2012 Tesla, by the way, who runs Tesla? What's his name? Very good. Elon Musk, right? Elon Musk runs Tesla. So what are the other companies he runs? He was the founder of PayPal, which he sold. He also has a company called SpaceX, right? And his mission is to what is Elon Musk's mission?
Send passenger craft to space.
Yeah, he wants to send people to Mars, right? So he doesn't have simple aspirations, just manufacture cars and sell it. That's not his objective. He wants to send people to Mars. That's the kind of thinking that people have nowadays. Entrepreneurs, they get some idea from somewhere and they work towards it. That's the beauty of them. They believe in it. Right? Okay. Okay, so Tesla 2012 cost you some $77,000, I think, something around that, right? In 2012, you could have bought 11,000 shares of Tesla for that amount. If you had spent $77,000, one car or 11,000 shares. So the same 2012 model of Tesla now costs about $40,000, right? So the value of the car has come down. Whereas the same 11,000 shares that you would have bought if you had spent $77,000 would now be worth $6.2 million. Okay. So the value has, the car had fallen. So if you had invested not in a car, but if you had bought 11,000 shares of Tesla, you would have now ended up with $6.2 million. Right? But if you had spent that money to buy a car, your net worth is now $40,000. Imagine the same amount of money where you had two different investment opportunities. You pick one, you end up with $40,000. You remember you're spending $77,000. Huh? This is 2012. But if you had purchased the share of the same company for $77,000, 11,000 shares, today you'll end up with $6.2 million. Which one would you prefer? Would you prefer to have bought a car in 2012, or would you prefer to bus it for the last 8 years and buy shares of Tesla? Yes, indeed. You should have bought shares, right?
Yes.
You would have bought shares for the entire village if you had purchased Tesla at that time. Isn't it? So investment opportunities, so many opportunities, so many assets that you can invest in. And the returns that they produce can be totally different. Right? So many examples. Now look at Bitcoin. 10 years ago, Bitcoin would cost you about $2. Right? $2 a Bitcoin. One Bitcoin, $2. How much is it today? One Bitcoin, how many dollars? Bitcoin, you know Bitcoin, right? It's virtual currency.
Virtual currency.
Yeah. How much is a Bitcoin today? It's around 20,000. Yeah, $20,000 a Bitcoin. Right. So if you had spent $2 10 years ago to buy a Bitcoin, today you would have ended up with $20,000. Right. Now, 10 years ago, if you had the option of investing $2 in Bitcoin or buying a pizza for $2, you probably would have bought a pizza, right? But 10 years down the line, the repercussion of your decision you made 10 years ago would be totally different, right? The end result of the two decisions, one of the two, if you had the option of making one decision out of the two, you would have ended up with a totally different outcome, right? So these are investments. You never know what is going to happen. Next year, you don't know what is going to happen. And so every 10 years, there is an economic crisis now. Now, who knows what is going to happen in 2030? Right? There might be a totally different crisis. Okay. So this is what happens in the world. There are cycles. Right? You get the peaks of economic growth, then a decline and a trough, and then a recovery. So likewise, the cycle continues. And these cycles will only continue, right? They will never stop. That is guaranteed. So it's how fast we adopt, how nimble we are as organizations and individuals to adopt is what really matters. Okay, so all of these cycles drive markets. Yeah. Now in grade 2, we learned that market forces drive prices, right? Market forces, basically demand and supply drive prices. So what drives demand and supply? It is sometimes sentiment. Could be macroeconomic factors like the political, legal, economic, social, and technological factors. Now, I'm doing just the basics, right? We'll start with the basics and then we'll go deeper. We are not going very deep into anything, just browsing the surface only. Right. Okay, so political stability. Now, if you are given a choice, you will prefer to invest, and let's say you had $1,000 at your disposal, and you're given a choice of investing. One is investing in a US company, right? Let's say Tesla, for example. You're given the opportunity to invest in Tesla. You're also given an opportunity to invest in a company listed in the Afghanistan Stock Exchange. Where would you prefer to invest? Will you prefer to invest in the US or in Afghanistan? Yeah, in the US, right? Why? Why in the US and why not in Afghanistan? Afghanistan is closer to Sri Lanka, isn't it? US is on the other side of the world. So why Afghanistan? Why not? Or why US? Why not Afghanistan? If there is an issue, you can easily fly to Afghanistan also. Yeah, exactly. It's stability, right? Political stability. So if you are investing, one thing you will look at is political stability, right? Which is why US is able to attract so much of investments compared to countries, some of the other countries in the world. And so political stability is one thing that investors will look at. Sometimes if the local economy is not stable, investors might prefer to invest in overseas markets if they find that those economies are more stable. Right? The legal and regulatory factors. How friendly are regulations? And this is also something that investors will need to look at, legal and regulatory factors. Right? Well, regulatory factors might include entry or exit barriers. How easy is it to enter a market? And if you want to leave a market, how easy is it to leave the market? Economic factors like the exchange rate, interest rates, unemployment rates, GDP, inflation, and commodity prices are also some of the factors that investors will look at. Obviously, you need to look at economic factors. You need to know what is going on in the country. What is happening to the demand patterns? Is demand growing? Which industry is growing? These are the things you need to know. So are you going into a mature and a saturated market? Now, for example, if another investor comes to Sri Lanka to open a bank, right? How viable is it going to be? Yeah. Or what if the investment is made in a totally new industry? Right? What kind of market are you investing in? Then interest rates. What is happening to interest rates in a country? So Sri Lanka, we now have low and stable interest rates, right? Which is exactly what an investor would need. He would want interest rates to be low so that he can borrow at low cost and invest. Then unemployment, right? So if unemployment is high, that means disposable incomes of people of that country will be low, which means demand for goods and services will also be low. So a company which wants rapid expansion will prefer to invest in countries which have high employment rates rather than high unemployment. GDP growth. Now, Sri Lanka this year, unfortunately, is going to be a negative growth because of COVID-19, but it has been the case with most of the other countries also. Right, and our GDP is expected to grow faster next year, and from there onwards, right? Now, to catch up with some of the other nations in the region, we need to continuously grow at high rates, positive rates actually. Then inflation. What is happening to inflation? Is inflation going up or down? Now, in countries like Japan, inflation is almost zero, right? They say that a loaf of bread, the price of a loaf of bread in Japan has not changed for 30 years. For the last 30 years, no change in price. So the government is trying to create some sort of inflation in Japan. In commodity prices, what is happening to commodity prices? Are commodity prices going up, going down? Right. The monetary and fiscal policy. Now, monetary policy. What is the difference between monetary and fiscal policy? Difference between monetary and fiscal policy. Yes, Ramarka, you're right. Monetary policy is about money supply. Fiscal policy is about government expenses. Good. Right. Yeah. Okay, so monetary policy is decided by the central bank, whereas fiscal policy is the treasury. Okay. It's about fiscal is about the government income and expenses. So if income is more than the expenses, it's called a budget surplus. If income is less than expenses, budget deficit. Sri Lanka has a budget deficit, which is expected to increase this year and then gradually taper off. Right? So monetary policy is about money supply, which means interest rates. Now, central bank decides on interest rates of a country. Right? So that's where the central bank decides on things like SDF and SLF, standing lending facility and standing deposit facility. What are the two rates, the benchmark rates? Four and a half is SDF, yeah. 5.5 SLF, right? 4.5, 5.5. There is also another factor. What is that? SRR, the reserve requirement, which is 2%. Yeah, good. Right, so these are the things central bank will look at when they decide on monetary policy. And fiscal policy is about taxes and government expenses. Then what is the stock market doing? Are stock market returns going up, down? Geopolitical factors, how peaceful is the country, and liquidity. Right now, because of COVID-19, the central bank had to print a lot of money due to extraordinary circumstances. They ended up printing money. Stock market returns have been quite attractive in Sri Lanka, and the market is continued to appreciate because of low interest rates, and there might be good interest rates, opportunities for you all to invest also. So being students of financial management, it's important that you have some sort of understanding. Try and invest in some of these instruments. Now, stock market, you all can invest some money and experience it. Right? Okay. Do you all have any questions up to now? No questions. Samuel has no questions. All right, very good. All right, so no questions means two things. Either you understood everything or you understood nothing. Yeah. Okay, so let's move on. Corporate finance, it's about how corporates deal with their funding needs. If they have a surplus, what do they do? If there's a deficit, how do they manage? It also involves financial accounting. Now, the treasury of a bank, it's like the heart of a bank. It can make or break a bank. Right? So this is where we are going to start off with. How do you ruin a bank? What's his name?
Nick Leeson.
Yes, very good, Nick Leeson. You all have read the slides, read the notes. That's good. The guy is called Nick Leeson. Where did he work? Finally, he worked for which bank? Yes, he ended up at Barings Bank, right? Now, Barings was a 225-year-old bank, 225 years. Even the Queen had her money in Barings Bank. Right? One of the oldest investment banks in the US, perhaps the oldest investment bank in the US. So Nick Leeson was, he was working, if I'm not mistaken, at Citibank and then ended up at Barings Bank. Initially at the London office, he did very well. Fantastic trader. Then he was promoted. He was sent to Philippines, and he did well in Philippines, and eventually ended up in Barings Singapore office. Now, when he was in Singapore, he was asked to manage all three divisions of their treasury. There is treasury has 3 units: front office, middle office, and back office. So Nick Leeson was asked to manage all 3 units. Now, this has to be ideally done by 3 different persons. There should be 3 different reporting lines, right, for control purposes. But Barings Bank didn't want. Barings Bank was very keen to cut costs, so they asked Nick Leeson to do double or triple hat, and he was asked to overlook all 3 divisions. Now, he abused his power, right, and went beyond his power. He was asked to do not to take lots of risk, but this guy did quite the opposite. He was like a bull in a china shop. Took lots of risk and ended up making lots of losses. Right now, the funny thing about Nick Leeson was, whenever he made a loss, he parked the loss in an account called 88888, 5 8s. Right. So whenever he makes a loss, the loss gets booked under 88888, that account. It was a customer account. So Barings Bank, the customer, the fictitious bogus customer was showing losses, and the customer's losses were reflected as the bank's profits, right? So there were huge losses for the customer. Bank made huge profits, and for this performance, Nick Leeson was rewarded. He was given lavish bonuses, sent on trips, and he was really enjoying his life, right? But it was a bogus account. Now, Nick Leeson was desperate to get out of it also. He started taking more and more risks. And eventually, he couldn't manage it anymore. Right? He took a big gamble against the Tokyo Stock Index, the Nikkei futures. He thought the market will be stable, and he was betting that the market is going to be stable, right? So if the market became volatile by any chance, he would end up losing lots of money. All of a sudden, there was an earthquake called the Kobe earthquake, right? And the Japanese stock index crashed. Lots of people died, and the stock index just crashed. And then Nick Leeson ended up making heavy losses, $1.6 billion, if I'm not mistaken. Something like that, right? And he was so desperate, he just fled. He left a note saying, "I'm sorry," and fled. He tried to escape to Germany and was caught, brought back to Singapore. He was sent to prison for 6 years. He was bailed out in 4. Right now, 3 days after Nick Leeson left that note and left the bank collapsed. Right? It had to file for bankruptcy. It could not honor its payments because the market became volatile. Remember when Nick Leeson left? So the bank had to pay its obligations, which they were not able to do. They were not able to meet the obligations. They went bankrupt. They had to file for bankruptcy. And Barings Bank ended up being sold for £1. Right? Just £1. ING Bank bought it. And they bought it for £1, and they sold it off later on for about $225 million. Right, so Nick Leeson went to prison. He was sent for 6 years in prison and released in 4 years. But while in prison, he started writing a book. Anyone knows what the book is? What is Nick Leeson's book? What is the book he wrote? You all can Google it and see. Very good. Rogue Trader. Yeah, he wrote a book called The Rogue Trader. It was a hit. And now there is a movie by this name, Rogue Trader. So please watch it. Right. It's the story of Nick Leeson. Fantastic movie, quite old, but still very interesting. So watch this movie, Rogue Trader. Right. So Nick Leeson made lots of money after he came out of prison from his book. And eventually he bought a football club. And now he owns a football club in UK. And so he minted money. And he also takes lectures on risk management. Right? So he's well off. Right? So that's the story of Nick Leeson. Now I want you all to watch this movie, Rogue Trader. You might have to download it from YouTube and watch it. Right? About 1.5 hours. Very interesting, fantastic story. So next week I will ask questions. Yeah, and there are a few more movies which I want you all to watch. So you don't have to watch it all next week. Phase it out. Now one movie every week, because you have to study also. Now. You'll be busy studying. You might not have lots of time for movies. So watch them 1 week, one movie per week. Road Trader this week. Next week you can watch watch The Big Short. I'm not sure whether you all can see if I type on this. Can you all see what I just typed? Okay, The Big Short, right? Big Short is about subprime mortgage crisis. Sorry, crisis, my spelling is wrong, but The Big Short is about the subprime mortgage crisis. And there is no movie called Subprime Mortgage Crisis, at least not to my knowledge. There might be. The movie's name is Big Short. It's about the subprime mortgage crisis. Then you also can watch The Wizard of Lies. Watch The Wizard of Lies. It's about Bernard Madoff. It's not Wizard of Lies is about Bernard Madoff. Remember, it's not Bernard Veerasinghe. It's Bernard Madoff. Bernard Veerasinghe is some other movie. Right? Your trade lecture. Yeah. Watch these movies. There are 3 movies. All of you would have watched Wolf of Wall Street. This is a very popular movie. Leonardo DiCaprio is acting. You would have watched this, but watch all of these movies. Fantastic. Only thing, every other word starts with F. But having said that, they're still very interesting, right? Okay, so the story of Nick Leeson. Any questions? Wolf of Wall Street, Fusita, what is, I don't understand the question. Wolf of Wall Street, is it so? What? Yeah, okay. Any questions up to now? Okay, so let's continue. Leeson was a former derivatives broker whose fraudulent, unauthorized speculative trades caused the collapse of Barings Bank in 1995. It was founded in 1762 and was UK's oldest investment bank, for which he was sent to prison. He lost $827 million pounds due to speculative investing, primarily in futures contracts at the Barings Singapore office. ING, a Dutch bank, purchased Barings in 1995 for a nominal sum of £1 and assumed all of Barings' liabilities, forming the subsidiary ING Barings. 2001, ING sold the US-based operations of ABN to ABN AMRO, $275 million, and folded the rest of ING Barings into its European banking division. And so they made huge money on that. Leeson made unauthorized speculative trades that at first made large profits for Barings. He used one of Barings' error accounts to hide his losses. The management at Barings Bank allowed Leeson to remain chief trader, while also being responsible for settling his trades, a job usually done by two different people. This made it much simpler for him to hide his losses from his superiors, right? So no one was aware of what he was doing. No one knew what he was up to. When Leeson placed a short straddle in Singapore, we'll see what a short straddle is later on when we get into derivatives. It's basically, if you expect markets to be stable, you would short straddles, right? Just remember like that for now. We will go into a little bit of detail when we get into derivatives, but for now, just that knowledge would suffice. And when Leeson placed a short straddle in Singapore and Tokyo stock exchanges, essentially betting that the Japanese stock market would not move significantly overnight. However, the Kobe earthquake hit in the morning of 17 January, sending Asian markets and Leeson's trading position into a tailspin. After failed bailout attempt, Barings was declared insolvent. Right, so this is the next guy, Jerome Kervel, who was at Societe Generale. A similar story. He is a French trader who was convicted in 2008, Societe Generale, for trading loss, for breach of trust, forgery, and unauthorized use of the bank's computers, resulting in losses valued at 4.9 billion euros. Societe Generale characterizes Kervel as a rogue trader and claims Kervel worked these trades alone and without its authorization. The bank states that Kervel was assigned to arbitrage discrepancies between equity derivatives and cash equity prices and began creating the fixtures trades in late 2006 and early 2007. But that these transactions were relatively small, the fake trading increased in frequency and in size. Kervel had been trading profitably in anticipation of falling market prices. However, bank accused him of exceeding his authority to engage in unauthorized trades totaling as much as 49.9 billion. A figure far higher than the bank's total market capitalization, right? So his losses was much more than the bank's market cap. Kervel tried to conceal the activity by creating losing trades and hidden profits intentionally so as to offset his early gains. Analysts suggest that unauthorized trading of this scale may have gone unnoticed initially due to the high volume in low-risk trades normally conducted by his department. Right? So he was asked to do low-risk transactions, but he exceeded his authority. The bank said that whenever the fake trades were questioned, Kervel would describe it as a mistake, then cancel the trades, after which he would replace that trade with another transaction using a different instrument to avoid detection. Right? So this guy was smart. He was intentionally making losses also, not only profitable trades, but also loss-making trades. Smart guy. The bank claimed Kervel had taken massive fraudulent directional positions in 2007 and 8, far beyond his limited authority, and that the traders involved in European stock index futures, Kervel was found guilty and sentenced to prison and banned from working in financial services. Koueko Adeboli, the next rogue trader, he was at UBS, at UBS's equity trading division as a trader analyst in London. Adeboli was arrested on the suspicion of fraud in connection with a loss of a then estimated 2 billion due to unauthorized trading at UBS's investment bank. Adeboli was found guilty of fraud and imprisoned, right? And the London whale, a guy called Bruno Ixil, who was at JP Morgan. Large trading losses occurred at JP Morgan's chief investment office based on transactions booked through its London branch. The unit was run by Chief Investment Officer Ina Drew, who has stepped down. A series of derivative transactions involving credit default swaps were entered reportedly as part of the bank's hedging strategy. Now, credit default swaps were responsible almost directly in the subprime mortgage crisis, right? Credit default swaps was the one that ruined the market. We will do swaps later. You will see that in a credit default swap, one party has to pay the other in the case of a default, right? So that is what happened during the subprime mortgage crisis. There were so many defaults that banks were short of liquidity to pay their obligations under the CDS. Bruno Ixil, nicknamed the London whale, accumulated outside CDS positions in the market. An estimated trading loss of 2 billion was announced, with the actual loss expected to be substantially larger. Okay, so these are the 4 rogue traders that you need to know. You need to remember their names, the 4 names, right? If you recall, Nick Leeson, Jerome Cowell, Kweku Adeboli, and London whale, or Bruno Ixil. And you need to know where they worked, right? So Nick Leeson was at Banks Bank, Jerome Cowell at Society General, Kweku Adeboli at UBS, and Bruno Ixil at JP Morgan. Right? So you need to remember those places, and remember the most important thing is that you need to understand that these guys messed up because they exceeded their authority. Right? They were asked to do a very simple thing without taking lots of risk and without gambling, but that is not what they did. They ended up gambling, exceeding their authority. So maybe yes, it can get questioned. It may not be, but you need to know what happened. Right? So one thing you need to remember is they exceeded their authority. It's very easy to remember, right? Remember their names, where they worked, and what caused it, what triggered it. One is they exceeded their authority. Also, there was poor monitoring. And these banks did not monitor the traders. Otherwise, this wouldn't have happened. If they had the proper audit, would have picked up very easily. Right? And not many people understood the products. Okay, so exceeded the authority and poor monitoring resulted in massive losses to these banks. Right? So that is what went wrong. Right now, any questions up to now? No questions, right? So let's move on. Right, so treasury is divided into 3 units. A typical treasury can be divided into 3 units: front office, middle office, and back office. Right. So now transactions will originate at the front office. They are the ones who are directly exposed to markets. Right. So the traders at the front office will be the ones dealing with the market. Yeah, they are the face of the bank to the whole world, basically. Yeah, and typically the front office will have direct reporting line to the MD, or the CEO, because the CEO is eventually responsible for the performance of the company, right? And the performance of a treasury is driven by the front office, so the front office ends up reporting to the CEO. Then the middle office monitors the risk of transactions entered by the front office. Right? The risk is being monitored by front office. So remember, middle office will never enter into transactions. They will only monitor the risk, and they will report to the CRO. Right? Now the CRO has a huge responsibility to play, because he will get information on market risk from the middle office and on operational risk from the other risk staff, including the middle office guy, maybe on credit risk, all types of risks, right? So he will end up doing what is called integrated risk management, right? A bird's eye view, which he will use to determine the next course of action, where the bank is heading, and what is the overall risk exposure of the bank. Then finally, the back office is the unit which executes transactions. All the transactions done at front office will be executed only at back office. So remember, there is these are watertight compartments. Right? The front office guy should not function in the middle office or the back office, and vice versa. Okay, so back office does the reporting, accounting, record keeping, and they will obviously report to the CFO, right? And remember, the front office guy should not get involved in accounting. Middle office guy should not get involved in accounting. And very important that back office also does not self-trade. They don't trade on behalf of the bank. Okay. Yeah, you have a question?
Yeah, in front office, normally what we do there is normal the forward bookings and special rates will be obtained by front office, is it?
Forward bookings and special rates on what?
Forward bookings for for
No.
LC,
Yeah.
letter of credits, and forward bookings for letter of credits.
No. Special rates for what?
Special rates for, I mean, maybe for a telegraphic transfer,
Okay.
or for a purchasing of a, issuing of a draft, then like that, and purchasing some currency.
Yeah. You're right, Subedha. What you're referring to is only one aspect of what front office does.
Mm-hmm.
That is the customer desk or foreign exchange transaction. Mm-hmm. In addition, there are other things that front office will do, right? But you're right. Yeah. Now they will be quoting exchange rates, right? You mentioned exchange rates. So I'll continue with the exchange rate example. Front office will be quoting exchange rates. That is because all transactions will have to originate at front office only. Now, the exchange rate that the front office gives will be based on, I told you that front office is the face of the bank to the market.
Okay.
Right. So whatever the exchange rate quoted by the front office will be based on what is going on in the market.
Yeah.
Now, if you ask from a back office guy, he might not have the same exposure to the market as a front office guy. He will not know what is going on in the market.
Mm-hmm. Yeah.
And for that reason, it is the front office that you'll have to contact to get special rates.
That is basically customer desk.
Yes, customer desk.
All right. Okay.
Yeah. They will also quote interest rates, special interest rates.
All right. Yeah. Interest rates. Yeah.
Yes. Again, typically from the customer desk or maybe from ALM.
Okay.
Yeah. Right. So the front office manages the bank's exchange rates and interest rates. Right. So they manage the bank's market risk. In other words. Okay. So my exchange rate and interest rates are about markets. So banks' market risk is usually managed by the front office. In addition, you can also have a little bit of trading equity. If you get into equity, then the front office will be managing equity price risk also. So the front office has to stay abreast of market dynamics. They need to know what is going on in markets. Okay, so they need to take risk, but they should not gamble. Don't gamble. Take calculated risks. So what is the difference between gambling and taking a risk, a calculated risk? Right. Gambling is where you close your eyes and take a bet. Taking a calculated risk, you go by fundamentals, evaluate options, and with proper approvals, you will have to proceed. Right. But gambling also, there is a science, but let's just assume that this is typical gambling, where you just close your eyes and pick your winners, right? So remember, front office does not gamble. Okay, now like Sumedha said, a front office will have different units, will be segregated into several units. Can have a money desk. We'll go into detail. An interbank desk, a customer desk, fixed income securities desk, ALM desk, derivatives desk, and even an equity desk. Various desks. Now, each of these desks will be performing different tasks, and depending on the size of the bank, you can have different staff manning these desks, right? So if it's a big operation that you're running, right, like some of the government banks and the big local banks in the country, you will have dealers specializing in each of these desks. But if you're a smaller bank, you might have one or two guys handling the entire operation. Right? So it depends on the size of the bank, the number of transactions, your volumes, and all that. But ideally, these responsibilities have to be segregated, because it's not humanly possible for dealers to be focusing on each of these areas all the time. Right? So this is where most of the junior dealers get slotted in the money market desk. Right? Having said that, it's one of the most challenging places to work also. Yeah, because typically the bank's SRR is managed at the money desk. Okay, there is a correction that you need to make. The SRR is not 6%, but it is what? You gave the answer earlier. It is SRR percentage should be 2%, right? SRR is 2%. It is not 6%. There are two cycles during which you should manage the SRR. Atharindu, you have a question. What does middle office do? I will come back to that. I think I answered also in part, right? That they monitor the risk of transactions done by front office. Just make this correction. SRR has to be 2% and not 6%, right? Not that it is fixed at 2% forever. Central bank has the right to change it. At one point, way back in about 2004, it was 10%. Until around 2010, if I'm not mistaken, it remained at 10%, and then it kept changing. So if central bank increases SRR, let's say it is 2% currently, what happens if the central bank increases it to 5%? What do you think will happen if SRR is increased to 5%? Now, these are the things that you should know. What happens if SRR is increased to 5%?
The lending capability of the banks will reduce.
Yes, you will have less funds to lend.
Yeah.
Right? It will also bring down what is called the deposit multiplier. Yes, you're right. Siva Prasad, you're right. Samuel is also right. Money supply tightens, decrease in money circulation, you're quite right. And the deposit multiplier will reduce. Now, for example, if the SRR is 2%, the deposit multiplier will be 50 times. That is 1 over 2%. Right? The inverse of SRR is the deposit multiplier. It is a number of times a single deposit can be multiplied. So if you put a deposit of 100 in a bank, and if the SRR is 2%, that means 100 divided by 2% by 2, it can be multiplied 50 times, basically. Right? You'll end up with eventually a liquidity supply of 5,000 if the SRR is 2%. And if the SRR is increased to 10%, then the deposit multiplier drops from 50, it drops to 10. 1 over SRR, right? So from 50, it drops to 10. That means a 100 rupee deposit will end up being adding liquidity of 1,000 rather than 5,000. Okay, so by increasing SRR, central bank, as you rightly said, can tighten money supply, and by reducing SRR, central bank can increase money supply. All right, so SRR is monitored in 2 cycles, from the 1st to 15th, and then from the 16th to the end of the month. Okay, so 2% of your total liability base has to be maintained for each of these cycles. The total liability base that was there in the previous month has to be maintained during these 2 cycles. And SRR is impacted by the central bank opening balance. Now, every bank will have a closing balance at central bank. You have a current account with central bank. How much of interest does central bank pay on SRR? What is the interest rate SRR on interest rate? What interest rate does central bank pay on SRR? For your money with central bank, how much do you get in terms of interest?
Is it 4.5?
4.5. Okay. Yeah, that is for SDF, right? For SDF, so if you have surplus money, let's say now your SRR, your reserve requirement, let's say is in absolute terms, the 2% comes to 100 billion, right? So if you are left with, at the end of the day, you see that you will end up with central bank balance of 150 billion. Right? Your requirement is 100 billion, and end of the day, you are ending up with a balance of 150 billion. That means you have a surplus or a deficit at the end of the day. Your requirement, yeah, you have surplus. Yeah. Right now, the surplus, what is the surplus amount?
50 billion.
50 billion surplus. So that 50 billion you can deposit at central bank. Right? If you deposit at central bank, you will get a rate of 4.5%. Right? That is SDF. Then if you figure out that you will end up with the SRR of 50 billion, your requirement is 100 billion, then you will have a your requirement is 100 billion, you figure out that you will end up with 50 billion. In that case, you will have a
Deficit.
Right? So the deficit you will have to borrow from central bank at a rate of 5.5%. So that is the role of SDF and SLA. Okay, 4.5%. What you mentioned, right? Okay. Now your requirement is 100 billion. That means every day you have to maintain SRR of 100 billion rupees minimum, right? 100 billion rupees minimum. Okay. So my question was, how much of interest does central bank pay on the 100 billion? They don't pay any interest. You don't earn any interest on reserve. Central bank does not pay any interest on reserve. Right? So it is actually a cost to you, because on one hand you have depositors to whom you have to pay a certain amount of money, whereas on the other hand you have to maintain a reserve, in this case 2%, on which you don't receive any money, right? Which means out of your total deposit base, if you have savings, current accounts of 2%, then that basically compensates for the SRR, right? So that is one way of bridging it. If you can match your SRR with your current account base, then you're on a fairly good footing, right? But if the SRR is increased to 10%, you need to have a current account base of around 10%. Sumit, I don't understand the question. What is the meaning of reducing the basis points? Meaning?
Yeah, that means now when now we get there's an announcement. Normally, we get announcements from CBSL that they are going to reduce the basis points. That means that they are going to reduce the interest rate. Is that the
Yeah, they will say they are going to reduce the interest rates by 50 basis points.
50 basis.
Something like that.
50 basis points means that is 0.5.
0.5%. Yeah, one basis point is 0.01%.
Right. Okay.
Right. So SRR has a direct link to the opening balance, central bank balance. Then foreign exchange settlements, if there is a rupee side involved, if it's a cross currency, there is no impact. Then treasury bill bond purchases or maturities. Interbank settlements can be repo, reverse repo, call money, check clearing. Slip transfers, SEFT. In recent times, you have SEFT, cash, common ATM switch. All these will have an impact on the central bank balance. Also, inward and outward RTGS balances. Then also the money market desk will be maintaining the nostro accounts of a bank, right? So there are two different words, nostro and vostro. What is the difference? What is nostro? What is vostro?
Nostro is where we maintain accounts at foreign banks, and vostro is where they maintain accounts in our banks.
Yeah. So nostro. Pardon?
Nostro is we maintain foreign banks accounts here.
Yeah.
On behalf of them. So vostro is like they maintain the accounts on behalf of us here. That may not be the correct answer, but
something like that.
Yeah.
So nostro means if we open an account in the US, let's say JP Morgan US, we deposit or Bankers Trust New York, right? And we deposit our dollars in that account.
Yeah.
That is called a nostro account, right? So we maintain a foreign currency account in an overseas bank. That's called nostros. So most banks have nostro accounts overseas. Vostro is the other way around. That is where overseas banks or institutions will have rupee accounts with us. Right? So remember, it has to be an overseas entity, but the account should be denominated in rupees. Vostro. Right. So the money market desk will engage in repurchase agreements or repos. Now, repos is, and you know what repos are, right? Repurchase agreements. What are repos? That is where you pledge an asset as a security. Now, in the case of a housing loan, right, you mortgage the property to a bank. Right, so you are pledging an asset. If the asset is a treasury bill or a bond, you can still pledge it as a security and borrow against it. Right, you can pledge assets and borrow against them. Right. So that's called, when you borrow, there is an implied promise that you will repay. Okay, so that's called repos, repurchase agreement. Few things to be mindful when you're borrowing under repos. Repo is an agreement where you actually sell and buy back a security, right? Sell and buy back. So when you repo, your security is leaving your possession. You lose control of the security. The party that acquires it has the right to do whatever it wants with it. Okay, but because you're losing a liquid asset in this case, if you borrow through repos, your liquid asset ratio is going to take a hit. You're going to take a hit on the liquid asset ratio. Now, for banks, what is the minimum liquid asset ratio requirement? How much liquid asset should the bank maintain? in terms of treasury bills, bonds, cash, all that? Any idea? The liquid asset ratio stipulated by the central bank is?
Should not be 2 to 1.
Yeah, minimum 20%.
20%.
Yeah, you need to maintain a 20% liquid asset ratio minimum. And if you fall short, there'll be penalties. So remember, if you borrow again under repos, your liquid asset ratio will take a hit. So if you're already at 20%, you might not be able to afford to borrow under repos. Reverse repos are the opposite. If you have surplus cash and you don't want to take a chance, you don't want to take credit risk, you can use reverse repos to lend. Right? So you're lending against treasury bills and bonds. There is another instrument called call money. Call money is a clean facility, interbank clean facility, call money. Right? So if you're short on liquid asset ratio, you can use call money to borrow. Then you have the interbank desk, which deals mainly in foreign exchange, like what Sumedha mentioned previously. Right? So the foreign exchange side of it is handled usually by the interbank desk. Now, foreign exchange we are going to cover in more detail later on, so we can skip this slide. Then the customer desk, which is a very important desk. Most of the profits, the sustainable profits of a bank is brought in by the customer desk. Right? I would say if a bank is to sustain its profitability levels, the customer desk should bring in about 80 to 90% of the revenue of a bank, which means it's very important that you retain your existing customers and try and get new customers on board, because that is where you have the highest margins. And the customer desk is not supposed to speculate. You can't, or you should not speculate on transactions if you are running the customer desk. Ideally, you should not. Right? The guys in the other desks, like the fixed income securities, or mainly the foreign exchange desk, are the ones who are specialists in managing or taking risk. So the risk should be passed on to the other desk. Right? So customer desk usually deals with the customer. They keep a margin and they sell or buy from the customer. If they're importers, the customer is an importer, the customer desk will keep a margin and sell maybe dollars to the importer. Right? So if the market is trading at 100 rupees, they will keep a 1 rupee margin and buy from the customer at sell to the customer at 101 rupees. That's how the customer desk operates. So the customer desk can also sell or buy fixed income securities from customers. And so all customer transactions has to be routed through the customer desk. Right. It's very important that you keep your customers satisfied, right? Like you satisfy the wife, you need to satisfy the customer also. So it's important that you maintain and build strong relationships. And you have to be very proactive in the market. Then you have the fixed income securities desk. Right? This is where the bank deals with treasury bills and bonds issued by the government, or you can even invest in debentures and all that through the fixed income securities desk. Okay, so we'll get into some of these instruments later on. You don't have to go through all of this. Just what you need to know are the types of desk and what they do under that. Right. So government securities, we will come back later. In asset and liability management, we are going into detail later on. But for now, ALM is about managing your assets and liabilities, right? So it's actually nothing new to learn. It is about what you do when you feel interest rates are going up. Should you have long-term assets or short-term assets? And what you do if interest rates are going down? Should you have short-term assets or long-term assets? That is what is looked at under ALM and ALCO. And so ALM desk will also monitor the liquid asset ratio. They will advise other desks about how to sustain the liquid asset ratio and how to keep it above the threshold of 20%. Right. So this is basically ALCO. We are getting into detail. You don't have to study these slides. Just remember, you should know what the types of desks are, right? So there can be a derivative desk which deals with various types of derivatives like forwards, futures, options, and swaps. You can have an equity desk. And if you have an equity desk, it will deal exclusively in equity transactions, which are very risky. Right now, unlike government securities, there is a possibility that equity might default. Companies can go bankrupt, whereas government securities will not go bankrupt. Now, at the exam, if you get such a question, is it right or wrong? Oh, sorry, I just noticed there are some questions. Nostro is our foreign currency account with them. Yes. Our account maintained in other foreign banks. Yes. Karthika, you're right. If you borrow from customers and give securities to back them, it's called repo. You're right. Methuj, can you please explain the repo with liquid asset ratio? Right. Repo is where you, if you have surplus securities, right? Let's say you have 1 billion rupees of, you have, let's say, 10 billion rupees of government securities with you, and you have a deficit of 1 billion on the reserve, right? To maintain reserve, you have a deficit of 1 billion. So what you can do is a repo is where you do a sell and buyback transaction, right? You do a sell buy. That means you sell your government security and you receive cash, and same time you agree to buy the same government security back, maybe in 6 months. Right now, this sell might be done at a price of 90. And the buyback might be a price of 95, right? So you're selling it today at 90, you're buying it back in 6 months at a price of 95, which means actually you're selling today at 90, buying back at 95, you're actually losing 5 rupees, right? 5 rupees on 90 for 6 months. Okay, so that's about a rate of 11%. You have borrowed at a rate of 11% roughly. Now, when you do a repo, you're doing a sell buy now. Right. So when you do a sell buy, your portfolio, which was 10 billion rupees, will drop to 9 billion rupees. Okay, so you have bonds now worth 9 billion rupees. Earlier you had 10 billion rupees. So that's why the liquid asset ratio will drop, because you will part with some of the liquid assets that you had. Okay. Yeah. Right. So any more questions? Right now, there are some terms which are used in markets. You can be either bullish or bearish on markets. If you are bullish on a market, that means you feel the market is going up. But if you take a bull, the bull's horns will be facing upwards now. Right? That means the market is going up. Bears, right? If you see how they find food, their nose and their head is turned downwards. That is how they look for food, isn't it? If you had observed bears. Right? So bearish is where the market is going down. Bullish is where the market is going up. You can say it's hawkish or dovish. Right? Hawk means going up. Dove is going down. Or you can say the market is going north or south. Now, risk management at a treasury. It's very important that you manage your risk in a treasury. Reason? Why do you think risk management is important in a treasury? Because transaction volumes are massive volumes. Minimum transaction size in a foreign exchange transaction is about minimum $500,000, right? You sometimes get in between also, but standard is 500,000 or even $1 million. $1 million, not rupees. That is the that is the minimum transaction sizes. It's roughly about 180 million rupees each transaction. Right? So you don't do retail in a treasury. It's all wholesale transactions, and also markets are very volatile, extremely volatile. Right? So a slight delay, there can be huge losses. So it's very important that you're quick to respond, and you know what is going on in markets. Right? So you should have limits, various types of limits like dealing room limits, the maximum exposure that can be carried by the dealing room, counterparty limits. What are the, well, if you deal with various counterparties, what are the kinds of limits you have to have in place? Dealer limits, each individual dealer will have their own limits. Portfolio limits, if you have one portfolio, what is the allowable maximum exposure? Stop loss limits, if you're making losses, what is the maximum loss you will incur? Then you should have operational policies and audits. Regular audits should also be carried out. And now this is where Barings Bank failed. They did not carry out proper audits. So why is risk management and controls needed in a treasury? As we discussed earlier, transaction volumes are huge, massive volumes, right? And volatile markets, massive volumes and volatile markets make risk management in treasury absolutely critical. Right, dealing limits. Now, in branches, you would have there are various authority limits, right? If a facility is above a certain level, if it's below a certain level, maybe the assistant manager can approve. Then if it's above that threshold, perhaps it has to go to the manager. And if it's beyond the manager's limits, maybe it has to go to the regional manager. Above the regional manager, maybe to the head of retail or wholesale banking. And above his limit, it might have to go to the CEO or even the board, right? So there are limits imposed for lending in branches. Likewise, if you take deposits, perhaps you have limits as well. So in a similar fashion, even in treasuries, you will have limits, right? You can have dealer limits. And dealer limits can be to control risk or profitability. Now, profitability, you can have stop loss limits or take profit limits or stop profit limits. Right? Stop loss means, unlike in a branch, a treasury is allowed to make losses. It's a given that treasuries will make losses. Some people say that it's good that treasuries make losses, because then you know that the treasury guys are busy. They are doing something. They're trying to do something. They might make losses on the way because markets are beyond your control. You should not lose money through negligence, but if it's the market, then it's understood. Okay. Treasurers are meant to make losses. Huh? That's the privilege of working for a treasury. You're allowed to make trade losses within certain limits. So those limits are called stop loss limits. And sometimes if you're very greedy, you might see profits and the market going up. you will not want to sell it off. You will not want to book your profit. You will think the market is going up further. You will want to hold on, but eventually you might find that the market crashes. If that happens, then the bank might end up losing a lot of money, right? So to avoid that, banks impose what are called take profit or stop profit limits. Then the risk limits can be an asset class limit, right? So if you are buying sovereign bonds, up to what amount can you buy? Or if you're investing in overseas markets, up to what amount are you allowed to invest? Transaction size limits. Right? Our treasury might not be allowed to do transactions, a single transaction above $10 million, right? It has to happen with the CEO's concurrence. Turnover limits, value at risk limits. Right? So likewise, you can have lots of limits. You can have position limits, risk control limits, dealing room limits, dealer limits, intraday limits, and overnight limits. Right. So various types of limits. Position limits is like if you're carrying foreign exchange positions, what is the maximum you can carry? Dealing room limit covers. Risk control limits are what we discussed earlier, like what is the maximum exposure you can have. Dealing room limit is the maximum transactions that the dealing room can do. Dealer limit is individual dealer limits. Now, a senior dealer might have a higher limit than a junior dealer. Intraday limit is during the day, what is the maximum exposure you can carry. Right? Overnight is usually governed by central bank imposed limits. They're called overnight limits. You might have what you call net open position limits, NOP. Right? That means the maximum foreign exchange position you can carry. So the further limits are you can have loss limit, maximum loss you can take, profitability limits, dealing room, dealer limits, intraday and monthly limits. The portfolio limit you can limit based on the asset type, the volume, asset class, or tenor. So remember, you need to have all these limits because transaction size is huge and markets are very dynamic and volatile. Portfolio limits can be using based on mismatches, right, or duration differences, convexities, exposures, and value at risk. We will cover this later on. Counterparty risk will control credit risk, settlement, pre-settlement, and issue limits. Right now, settlement limits or settlement risk is also called Herstatt risk. Why do you think settlement risk can occur? Settlement limit. Right now, when you buy shares, if you have done equity transactions, is there settlement risk? Okay, Kartika, your question is who decides on limits? Central bank or banks can be both. Certain types of limits are imposed by central bank. Like limits like the net open position is given by the central bank. Right? But you can have internal limits like dealer limits, for example. Purely at the discretion of the bank can decide what sort of limits they're going to impose. But the only thing is the bank's limit should not exceed the central bank limit, right? The maximum cap you can have is the central bank imposed limit. You can't have beyond that. You can't breach central bank limits. So, this question: if we cancel any special rate obtained from Treasury, provided we inform it overnight, does it always have to be borne by the branch? Any special rate? I am assuming you are referring to FD. No, sorry, not FD. Foreign exchange rates. So, if you obtain a special foreign exchange rate from Treasury, provided we inform it overnight. So why do you have to wait overnight?
In case if we cannot cancel, I mean, if we forget to do that on the same day, tomorrow, the next day morning, we'll inform them. So there will be an exchange loss. So that exchange loss has to be borne by the branch, or will it be borne by the treasury? What is the procedure?
Pardon?
What is the normal procedure?
Yeah,
You take any special rate?
yeah, there are two interesting things. I think this is coming out of your experience. You would have experienced it at some point, right? You're talking out of experience, right?
Yes.
Yeah.
From experience.
And yes. The second thing is you used an interesting word. I don't know whether it slipped out or you intentionally used it. You said you forget to inform.
Okay, it means during the day, in case someone obtained the rates, and we dragged on until the end of the day. So then the customer, if in case the customer doesn't want to do that transaction, we had to inform later, or at that time all would have gone out. So we would have, we normally send the mail, but the next day morning they will get to know that the special rate has been cancelled.
Next day morning, who will get to know?
Now when we send the mail, sometimes the people who are, on that, like the people who are giving the rates
At the branch.
especially the
At
people
the
who are working at the customer desk, if they are not available on the next day only, they will get to know this when we send the mail. So sometimes later in the evening, let's say if we do like do such a transaction like this, so what will happen?
Yeah. Okay. Now, since you use the word forget, right? Forget is it amounts to negligence, doesn't it?
Yeah, negligence.
You can't forget, right? You're not supposed to forget it and then conveniently forget and sometime later remember.
Yeah.
Right.
Let's say not forget. Actually, the customer wants to wait. The customer waits until the end of the day, and then customer decides not to do this.
Okay.
And he wants to cancel this.
Yeah. If you forget, there is no doubt the branch will have to take the loss, right?
Right.
And the other thing is now, if you forget, and actually the bank might end up losing a lot of money. Okay, so the branch will have to be held accountable if the branch forgets.
Okay,
yeah.
But that is a problem.
If the customer wants to have the flexibility to decide at the end of the day, let's say after 3 hours from the point of quoting the rate, usually it is not allowed. If it is allowed, then the bank will have to charge a huge margin. Right? The rate that the treasury quotes will not be valid for more than maximum 5 minutes, and not even 5 minutes it should be allowed. But if it's at the end of the day, there should be a huge margin, maybe even the normal rate, even at the normal rate, right? And if the customer cancels a special rate in the evening, and if the market has moved against the customer, right, he'll be canceling because it has moved against him. It says an exporter, he books forward, but the market goes up, he wants to cancel, right?
Yeah.
If that happens, then there'll be a loss that the bank has to incur.
Okay.
So that cost will have to be charged back from the customer. It should not be tolerated.
Right.
There is no choice but to charge it from the customer, because anyway the bank will be paying to cancel the transaction.
Right.
Yeah.
Okay, thanks.
Right. Any further questions? Okay, so settlement risk is very, very important. Now, if you have done, if you're dealt in, if you have bought or sold shares in the stock market, you can only do it in the stock market. If you have done share transactions, you have the settlement risk, or there is no settlement risk. Stock market, there is no settlement risk, right? Because the stock exchange guarantees settlement. Stock exchange makes sure settlement will go through. But when it comes to foreign exchange transactions, there can be settlement risk. Right? Even repos, there is no settlement risk because it happens through what is called DVP, RVP. Settlement happens simultaneously at the time of dispersing securities or receiving funds. But in the case of foreign exchange transactions, settlement risk can happen. Right? That is because of the timing difference. Now, let's say, let's assume, just for example, I will use two banks, right? HNB and Commercial. Let's say HNB purchased dollars from Commercial, right? So HNB Commercial is selling the dollars to HNB. Now, to settle this transaction, HNB has to give rupees to Commercial now, and Commercial will have to give dollars to HNB, right? Now, on the settlement date, HNB will be giving rupees to Commercial during our trading hours. It will settle through RTGS. But the dollars that Commercial gives will come only at the end of the day. During US open times, right? Because US market has to open for Commercial to transfer the dollars. Now, in between, after HNB gives rupees to Commercial, if say Commercial goes bankrupt, right? Or Commercial's Nostro account goes bankrupt, then the settlement might not happen. Whereas HNB has already given the rupees. Okay, so in that instance, there can be default. That's called settlement risk. It has actually happened to a bank called Herstat. So it's called Herstat risk, in other words. Okay, so these are the risks that you need to be mindful of. And authority is vested with the Treasury to ensure compliance. You need to comply with all the regulations, with central bank regulations. Now, there are, once a transaction is done, it has to be informed to central bank within half an hour. Otherwise, there are going to be penalties within the overall authority delegated, and provide specific sublimits to each dealer in the department. Each dealer is responsible and accountable for positions maintained, right? So you have to own up to your activities or your subordinates' activities. And remember, it has to be team effort. In a Treasury, serious team effort. If you don't have team effort, it's not going to work. You also need to have what is called a trading policy. Policies should be there for trading. Daylight and net open positions, you need to have policies on that. What is going to be your maximum threshold levels? All trades must be within delegated limits, right? So these are the things that need to be covered in the policy. Policy must be communicated in writing. It can't be hearsay, right? It has to be signed off by all dealers. Mismatched positions must be contained within specific limits. Excesses must be reported promptly and approved. Undertake transactions only with the approved counterparty subject to approved limits. Each dealer must ensure profitable use, covering of surplus, deficit of overnight cash balances as projected. They should not enter into deals where the agreed rate is substantially different from market rate. So you have to deal within the market levels. Dealers must act prudently at all times in the best interest of the bank, and deviation from the above needs specific approval, right? You can't deviate from some of these, but certain things you can with approval. You also need to have operational policies. Roles of all parties transacting, processing, recording, checking, and monitoring of transactions must be clearly defined and well understood by all parties, right? So each person should know what your role is. List of duties should be complete and clear. Each dealer is sole responsible and accountable for the positions maintained. Properly recorded in the dealer's own position record. At the close of business, you need to compare with the settlement record. All the deals must be properly recorded on dealing slips and submitted to back office with minimum or no delay. Dispute resolutions also should be in place. If there's a dispute, what are you going to do? Then why do you need ethics? Now, what are ethics? What do you mean by ethics?
Good practice.
Yeah, you need to have good practices, right? Oh, for example, let's say it's like this. Something that is unethical may not be illegal. And now, for example, Sumedha, before you got married, you would have had 10 girlfriends in 10 districts. That is not illegal, right? But it may not be ethical. But if after getting married, if you had 10 wives in 10 districts, that is illegal. It is not ethical, right? Not ethical either. So ethics, what is unethical may not be illegal, but what is illegal is always unethical also. Okay, so there's a subtle difference. Now, these are unwritten laws which need to be practiced. You need to practice ethics. So why do you need ethics? One thing is to ensure that there is a level playing field in the market. Markets should have level playing field. Okay, so it also means market should not be manipulated. You can't manipulate markets. You should not manipulate markets. Whether you're a big bank or a small bank, you should have equal opportunity to make money. Right? There should not be an undue advantage with certain parties. It also means, all of us, when we were young, when we were schooling, we dreamt of becoming doctors. None of us wanted to become conductors, right? We wanted to become doctors. Why? Because doctors practice ethics, isn't it? It's at least deemed to be an ethical practice. So we aspire to be ethical. We aspire to be doctors. So we study, we learn lots of things, and ultimately, not all of us become doctors, right? The brainiest guys end up becoming doctors. Then the guys who are left get into other types of jobs. They become bus drivers, three-wheeler drivers, and bankers. Yeah. So why do we need or aspire to be doctors? Because of ethics. So ethics is very important to attract talent. Now, once you attract talent, like take the profession of doctors. Once you become a doctor, how many would leave the industry or the practice? Not many. So you can attract and retain talent if the industry or the practice is ethical, if there is ethics being practiced. Right, so the controls in a treasury, you have access control. Not everyone can access a treasury. Dual authorization is there. Confirmations need to be very spontaneous. You need to have reconciliations, revaluations, accounting, settlement procedures, audit policies should be in place, limits, disaster recovery, like in COVID-19, how do you react? What are your contingency plans? Voice recording, right? Every call that is taken to treasury is recorded. Then one of you all had a question on middle office, right? The role of middle office is to monitor the risk taken by the front office, to ensure that the front office adheres to limits. Then you can calculate risk like value at risk. And finally, the back office will ensure that all transactions entered by the front office are executed, right? Accounting, record keeping, all that is done by the back office. Settlement. Okay. Right, so that is it for today. Do you all have any questions? Right, so if there are no questions, we can wind up, and I will see you next week at the same time. Thank you very much. Stay safe. We'll meet next week.